All right.
Okay.
All right, let's get started so you can go out and sell some real estate. Talking about money today, right?
Yeah.
I see Caroline's collecting something, collecting money.
Money. I need money.
Attending today was not contingent on financing. All right, we're going to talk about the financing contingencies in our two contracts that we see most frequently in our area, one being NABOR, one being FRBAR. I think we'll be able to get out of here long before 1 o'clock. And if we don't blame me, blame Doris. By the way, this is Doris. She is my paralegal. She is a licensed attorney in 2 states, but not in Florida. And she does great stuff in our office. So if you ever have a question, call me. I usually ask Doris for the answer, then I'm able to share it with you. She does mostly litigation, but she's learning more and more about the transactional side of the practice. So she's a big help. Anyway, we're moving on with the financing contingencies here. We'll start with the NABOR contract. It's in section 4 of the NABOR contract as to what happens if your transaction is contingent on financing. And I'm assuming that so many of you are here today because you rarely get a financing transaction because so many cash deals in our market. I learned long ago not to imply that anyone could not pay cash for property on Marco Island when I suggested to one of my clients to remember that if they're going to sell stock in order to buy a multi-million-dollar condominium, that there was a 10-day time for the stock sale to clear and the funds to be available. And they were insulted that I suggested that they would have to sell stock to buy a multi-million-dollar condominium. So I don't make that suggestion any longer. But we still do have some financing transactions, so let's talk about what happens with the NABOR contract. Okay, we had a discussion some years ago with the attorneys on legal resources. There was a disagreement as to whether or not the NABOR contract was truly a financing contingency. Now, the first few words of that paragraph say that the contract is contingent on the buyer obtaining financing, and I pointed out that that's a contingency, but believe it or not, out of 8 attorneys on the committee, 6 disagreed with me, and I could only convince 1 that I was right. So we slightly tweaked the words, and I can assure you, being the only litigator on the committee, that if that contract ever goes to a lawsuit on the basis of the financing contingency, the entire transaction is contingent on financing. Okay? The buyer has an obligation to close only if the buyer gets the financing, and it is secured by a mortgage against the property in the sale. So a few years back, the contract did not specify anything about the property that was going to stand as security for the financing, and we revised the contract to make it clear that the buyer has to apply for a loan to be secured by a mortgage on the property that the buyer is purchasing. Because we had transactions where buyers were going out and getting a mortgage, trying to get a mortgage on some other property, and coming back saying, I applied for a mortgage on those terms using this other property's collateral and I got turned down. And the contract didn't specify what property that the buyer had to use as security. Now the contract makes it clear, okay? Now when we move on through the paragraph on financing, you're familiar with the paragraph that has blanks in the paragraph to include the type of loan being sought, and therein you really do need to check the blank. Conventional, VA, FHA, or other. Now, other, I'm not sure, I have never seen other checked. I'm assuming that there's some financing out there. I've seen a lot more of that in commercial deals, but for residential, probably not. If you don't check a box, conventional is the default, and that's a good thing, it's a little easier to process. If you do check FHA or VA, remember that you have to attach the FHA VA addendum. And the primary purpose for attaching the addendum is that both of those loans have to do with the contingency that the property appraises. Okay, other than that, the financing contingency in the NABOR contract doesn't have anything about appraisals. Okay, so it's just about getting a financing in accordance with the terms of the loan. So be sure you add the FHA and VA addendum, and that's in the NABOR forms directory. You can find that wherever you use your forms. So be sure you add that if you're going to climb up a customer that goes with an FHA or VA loan. Nothing wrong with FHA or VA loans. In fact, they're fairly attractive, but they do have that appraisal requirement. Some of the old clauses that required the buyer, that limited the closing costs the buyer could pay, things of that nature, are really not in play anymore. So the appraisal is the primary contingency with an FHA and VA loan. Now, there are also blanks in the section for loan terms. So you fill in the blanks, which are the rate, the date that the mortgage is going to be a term for, Be realistic when you're filling those blanks in and fill them in. If you, for example, know that 30-year fixed rate mortgages are 5.75%, why would you fill in 4.9% on the mortgage contingency? And then the contract requires that the buyer apply for a loan at a financial institution that makes that type of loan. Unless you are aware of a financial institution that's making a 4.9% loan in a 5.75 market, it doesn't make any sense to do that. So and by the way, all my recommendations today are subject to approval of your broker, so that's my disclaimer. But my recommendation is that you be realistic in discussing with your buyer, because what's your buyer really looking at? It's not so much the interest rate, but what most people look at is what's the monthly payment. Okay, so look at what will choke the buyer and put that in as the maximum interest rate. So if it's 6.5% or 7%, put that in, but make something that makes sense, not a pie in the sky number, because if you do that, think about it when you're the listing agent and an offer comes in and you see a financing contingency and somehow the contingency is significantly below the market rate, and you look at that, you look at your customer, and if you're not making some comment to your customer about, look at this contingency, the current market rates for 30-year fixed rates are 5.75, and they've got 4.75, 3.8, whatever it might be, they may not be able to get that financing because it doesn't seem to exist. That can, or if just your customer looks at that, doesn't that kind of hurt the whole transaction? I think that people really need to have at least a modicum of trust that the buyer is going to do what the buyer says the buyer is going to do, and the seller is going to do what the seller says they're going to do. And when you start a transaction with a contract that looks like it can't happen, then how does the seller feel about that buyer, number one? And if you let that happen and it falls through, how does the seller now feel about you as a professional that you suggested the seller sign a contract with a contingency that the buyer can't get a loan like that? The buyer backs out because the buyer got a 5.75% loan commitment, but it wasn't 4.9. The buyer then decided, I really want out of the deal because I got cold feet, I didn't like the trend. I don't want to buy the property, I changed my mind, I found something else.
Is there an objection to putting current, actually writing current or a market rate in there?
Well, we talk about that, us lawyers talk about that all the time. Question is there any problem putting in market rate prevailing? In fact, the FRBAR contract has that as a default, it's prevailing. But we really don't know what that term means until a judge or jury tells us what that term means. And if we're talking about market or prevailing, I always step back and I go, okay, if I went to SunTrust and asked for a 30-year fixed rate, is that the same rate that I get at Truist? Or is that the same rate at BOA? I mean, I'm pretty sure that it's not, although it could be. And they I think Bankrate publishes, mortgage 30-year fixed or CDs. You go, look, there's a spectrum. Maybe, I don't know what the rate is today, but it may be 4.9% up to 5.3%. Well, what's market? Is it 4.9, 5.3, 5. So if we put those terms in there, we'll only find out what they truly mean when we litigate. And I get that case, and as you know, I litigate. I'm one of the few dirt lawyers that does. If I get that case in my office, I have to look at my client and say, this is a gray area. I can't tell you how this is going to play out. I can make a great argument on either side of the coin. It's going to cost you $50,000 to $100,000 to find out. Where do we go? Okay. Now, after we have that discussion, does your customer turn to you and say, why did you put that in the blank? Okay. Now, I'm not going to have that discussion very often because it doesn't happen very often. But I always think that you need to build your operation for what goes wrong and not what goes right most of the time. We buy car insurance because we don't know the day we're going to get in the car accident. If we knew the day, we would buy the insurance the day before, then we would get rid of it the day after, okay? So you have to build, in my opinion, you have to build a system that you do things that works even when things don't go well. And I do not like to talk to somebody that wants to blame you guys. Everything that goes wrong with a real estate transaction is visited on your shoulders, whether it's your fault or not, okay? So that's just one area that you put prevailing market. I don't like that it's in the FRBAR contract, but it is. It's a default, but I don't know what that means. And I don't know any other attorney that I've spoken with, at least here, nor on the Board of Attorneys Committee in Orlando, that knows what that means. Okay, the FRBAR committee thinks they know what it means, but I don't think there are any litigators on that committee. Okay. So, you can put that in. I think you're better off putting in a real number, and again, the number that I recommend is not what it is today, but what your client can live with, because we know in a rising interest rate market, putting in what it is today doesn't work in 30 days when your customer is qualifying for the loan. Putting in what your customer hopes the rate will be in 30 days also seems to me to be foolish, because again, I think that sends the wrong message to the seller. But I'm an attorney, not a realtor. You all know what you're doing out there, so these are just some suggestions from me. Okay. So, under the NABOR contract, the buyer must make a loan application within 5 days of the effective date or such other date as you put in the blank that provides for the amount of time for the buyer to make a loan application. This is one of the buyer's biggest Achilles heels in all of the closings that are contingent on financing, because they don't apply for the loan while they're here on Marco Island or Naples. They apply for it when they get back up north, because they don't want to take the time while they're on vacation to apply for a loan. Well, we have a 5-day deadline. Now, that is not a time of the essence deadline, so it's possible that if they applied 6 days after the effective date, they're okay. But the number one thing I ask for when a buyer wants to get out of a deal for not getting a loan is I look at the seller and I say, do you want the deposit? Do you want me to ask for it? They say yes. I then look to the buyer's representative and I say, would you please get information from your buyer and find out what date the buyer applied for a loan? I also ask that they provide me with evidence that the buyer made a good faith, diligent effort to obtain the loan. And I can tell you my estimate would be that 7 times out of 10, the buyer did not apply timely for a loan, and that's why they didn't get a loan in time, and that's why they're trying to get out of the deal. Now, for whatever reason that they didn't apply, sometimes they didn't apply because they changed their mind about getting a loan anyway or buying the property, and they know if they don't apply until late, they won't have a loan in time. But most of the time, I think it's because the realtor didn't push them to apply for a loan. And I think they need to apply locally, because the local lenders are a lot better generally at processing loans on these properties than you are in a bank that they go to up north. And the worst are the banks that they go to up north that they have a great relationship with, and now we've got to work with somebody in requiring insurance and do things that just doesn't fit into our operation down here. So please be sure that you make it clear in writing to your customer so that it doesn't fall back on you. They have to apply for a loan right away. They may ask you for a recommendation. You can assist them in doing so, but make sure they do that, because that is the number one reason that I say you haven't timely applied. You can't use that as an excuse for not closing. Give the seller the deposit. Okay, now remember the effective date under the NABOR contract, and they're different under NABOR and FRBAR, is the last dated initials or signature on the contract form. So we always remind you to get your folks to date when they initial or date when they're signing, so we know what that is. Otherwise you go back and forth for a week trying to get a deal, and the only date is the date of the original offer. That's the effective date of the contract. So now how can you apply for a loan within 5 days of a contract effective date that's 7 days before it even became a contract? Yes, ma'am.
You said something about the appraisal on the NABOR. What did you mean by that?
The contract is not contingent on an appraisal or the property appraising, with the exception of if you can't get a loan because it doesn't appraise, then you're okay. All right. Okay, the FRBAR contract does address appraisal specifically, and we'll get to that in a little bit. Okay.
May I ask one question? I forgot, with the 5 days, for instance, coming Monday's a holiday. Is it counting just regular calendar 5 days if it lands on a holiday or goes to the next one, or do you skip the weekends?
No, it counts all the days. The only time that a holiday matters is if it's the last day for performance.
Okay.
And then under NABOR contract, we go to the next day that's not a holiday.
Okay.
Okay. Yes?
So so we have like a couple and you're doing the initials and then the date. Is it okay to just use one of them initial it? Date it? Like when you're doing e-sign, or should you do both?
Well, it's fine, because if you've got the date, basically the last date is going to be what counts. So if you've got 2 sets of signatures and only one's dated, the only problem that I see with that is an argument that the second person's signature was not affixed at that time, and somehow they argue it wasn't an agreement. I don't think that's a good argument, but I think the better practice is that everything get dated. But as long as you've got that, the last dated initials or signature, you've got one that's dated, so if that's the last one, that'll count.
It gets really messy on that first page when you start getting a lot
I-
of dates in there as well.
True, but, you know,
What about insurance? What if they can qualify for the loan, but the insurance blows them out for basically, everything else?
well, if they can't fund the financing, if, we'll get to this, but if they've waived the financing contingency, their deposit's at risk. And the same thing happens under FRBAR. So if they get they get a loan and they think everything's great, and then it's contingent on getting the insurance. If they can't get insurance, then they've got a problem if they've waived the financing. Okay, if they haven't waived the financing and it's still contingent, then that's the same thing as a bad appraisal. They can't get financing because something happens. It's not their fault. Okay. What I'm seeing most of the time is that they can get insurance. It's just extremely expensive insurance. Okay, and that's an entirely different animal. Okay. Yes, ma'am.
Back to the 5 days, so weekends are included?
Yes.
All right.
But if the last date for performance falls on a weekend, it would go to Monday, unless Monday is Memorial Day, in which case it goes to Tuesday. Okay. All right. Okay.
Oh, I had a buyer that, we were about, in the process of closing or whatever, doing the deal, and he said, oh, if my FEMA flood insurance is outrageous, we're not going through with it. How can he pull out if it's not even stated on the contract?
Okay, the question was, buyer gets to near closing and finds out that the flood insurance is outrageous and they want to back out now because the flood insurance is too high. The contract's not contingent on that at all, so if they want to back out solely because the insurance premiums are too high, their deposit is at risk.
Okay.
Okay, now, just segueing into, if the seller knew that the insurance rates were going to be super high and didn't disclose that, that could be a failure to disclose a material defect that would not be readily observable by a buyer, and would be an obligation of the seller to disclose that under Johnson versus Davis and under the contract language. It might give the buyer the opportunity to get back their deposit. But how would we find that out? We go to court, and that costs $50,000 to $100,000, which I am happy to get paid, but normally it's not in our client's best interest to go litigate those issues. So they don't have the right to back out. The NABOR contract has a clause in it that says the buyer is supposed to check out the availability and cost of insurance before making the offer. If they fail to do that, they're kind of stuck with whatever they find out after the fact.
Yeah, my seller doesn't know if the FEMA's going up or not, she's just.
Well, I have heard that. We're trying to look at that from a standpoint of should we do something with the contract. Insurances are really a tough issue. I know they're looking at that in the FRBAR contract as well. FRBAR is right now much more concerned with other issues with their contract than they are with the insurance problem. But it is a problem, and so for those of you that are aware of that, we don't have a contingency clause nor an addendum to attach to the contract that's in the forms library that says, hey, if insurance rates are really high, you can back out of the deal. So if you want to put something in like that, I suggest that you have an attorney help draft something that would give the buyer some kind of protection if rates were above some certain amount. Okay, but if I represent the seller, I want something more specific than if I think if the insurance rates are too high, I get out of the deal.
Yeah.
I don't know what that means. If I say if the flood insurance is going to cost more than whatever, I could cancel a transaction. Okay, I know what that means. Then the seller understands. Okay.
Yeah, the buyer assumed her.
Well, you could transfer and you're on the on-ramp that gradually escalates. But a lot of these newer properties and a lot of the people are self-insured. So you're buying a self-insured property or you're buying new construction, you're going to get stuck with whatever the current FEMA 2.0 rate is. So that's when they're here as opposed to down here. Yes?
It is required now for new listings to check off if it currently has flood insurance or not. So at least as the buyer's agent, you'll be able to give that information, to your buyers as you're showing the property. Because if it's checked no and they are self-insured, then it's probably gonna be really high.
Okay, so understand the insurance problem is a completely different animal, and whether it's expensive or not, it doesn't have anything to do with whether you have mortgage financing or not. It just has to do how much it costs you to insure the property and perhaps meet the requirements of the lender. But expensive insurance under either the FRBAR or the NABOR contract is not an out under the contract, nor under any addendum or rider that I am aware of. And I really don't like realtors to write their own language into the contracts or to have your customers do it, because I think what sounds great when you write it doesn't sound so great when people are arguing about what it means. So I think you should get an attorney to do that, and I think it'll probably play out better. And we may be getting an addendum like that in the near future in NABOR's contract, but the wheels of these things turn slowly. Okay. Yes.
So if I said to my buyer, we need to have an attorney help us write that, and they say, how much would that be? How much would
You'd
that
have to ask the attorney. I'm not going to go into pricing, but it's usually not. If we're doing the closing, it's not going to be much. If we're not doing the closing, I'm not going to be too interested in writing an addendum, because it's just not going to. I'm not going to charge a fee big enough to make it worthwhile opening a file, bill it, get paid, do all that work on it. Okay. Anybody else? All right. So we're moving on and into the financing contingency. The NABOR contract has a really different kind of contingency. Number one, it is a financing contingency, which means if the buyer doesn't get the financing and able to fund and close, then the buyer can back out of the transaction, okay? However, the way it works is there's a line to fill in that the buyer has to waive the financing contingency by the financing contingency deadline. If you leave the blank without filling anything in, it's 45 days from the effective date. And if the buyer waives the financing contingency, it becomes a cash transaction, subject only to the buyer's right to extend the closing for up to 10 days if the lender needs up to 10 additional days to meet CFPB requirements. Okay. And by the way, the buyer's application for a loan also has to meet the CFPB requirements. Okay. So if we get to the 45th day or whatever day you've put in that line, and again, here's a good example of do something that makes sense. If you're going to have your buyer is going to go apply for a loan within those 5 days, there ought to be some idea of where the buyer is going to apply. So as you're going into a transaction, I recommend that you have the buyer make a contact with a lender and find out how long it's taking that lender to process loan applications. It varies by lender to lender and the personnel they've got and how many loans they're getting. The other thing I'm going to make a recommendation under either contract, and I say this every time in each class, is remember that there are more than 3 days in a month. The 1st, the 15th, and the 30th are all wonderful days, but the 12th and the 22nd, the 23rd, the 8th are also terrific days, and we don't have all the closings happening on those days, which means we don't have all the lenders trying to process loans for closing on those days, which means you have a much better chance everything goes smoothly on the 8th, the 22nd, than you do on the 1st, the 15th, and the 30th. Okay, so when you're writing up a contract, look at a date that's going to make the contract easier to close for everyone. And with financing contingencies, you really need to look at those days because the lenders get backed up just like everybody else. And the whole nation, realtors in the whole nation have the same calendar that you guys do. And I think they ripped out all the days except the 1st, the 15th, and the 30th. Okay, do you guys get those from NAR? Okay. But those are the days that most contracts are written to close. So go off of those days, go off the beaten path and go to the 22nd, the 8th, 9th, something like that. And you'll find that that will, again, build a system that is planned to avoid problems that don't happen all the time, but can happen. And it's pretty easy to do that if we remember there are other days in the calendar. So anyway, we get to the 45th day or whatever day you put in the blank for the financing contingency waiver, and the buyer then has the right to waive the contract, waive the financing contingency. And if the buyer doesn't waive the financing contingency, what happens to the contract? It remains in effect, okay? But there's still a financing contingency. Now, listing agents put a lot of pressure on buyers to waive the financing contingency, so it turns into a cash deal. If you convince your buyer that because the loan officer said everything looks great, and they should waive the contingency or they're going to lose this property, because that's what the listing agent said. There's a backup offer, got another offer. This guy found out, another guy in the building found out it was for sale, and you sold it for that much, so pay more for it, all the stories you hear. And the buyer waives the financing contingency and something goes wrong, who's going to have liability? They're going to blame you anyway, right? So even if you have no liability, how many people is that buyer going to refer to you for future purchases and sales? Not a lot. Okay, so be careful with that. I think, again, that's an example of one of those issues that I think you send it to the lawyer, let the lawyer handle it. And I don't have a problem with people waiving the financing contingency because we all make those business decisions. We buy, if anybody's bought and sold stock, you buy stock. Sometimes it goes up, sometimes it goes down. Okay, but we make those business decisions. And if they make a business decision after full disclosure of the risk that they've made it, they can make that decision. So I don't mind if my clients waive the financing contingency, but I make sure they understand it, and I do it in writing. You can do the same thing, but why do you want to assume that liability? Okay? Because I haven't heard, I don't think I've had a transaction where the buyer was unable to get a loan that waived the financing contingency, that the buyer didn't in some way claim the realtor told him to do it. Okay? So, whether you told them that or not, that's what they're going to say. And they look for you to help bail them out. Okay? So, they waive the financial contingency. What can happen though? The seller can terminate the NABOR contract anytime up until the buyer gives the seller notice that the buyer's waiving a contingency. And then the buyer gets back the deposit. So your risk there is that you don't get a commission. The risk if they waive it is that you get sued for the deposit because you told them and pressured them to waive it. Okay, you can waive those. You can weigh those risks and look at the way you think you should do. Okay, now the buyer can't terminate the contract under the NABOR contract just because the buyer didn't get financing commitment, financing promise, acceptable financing at the 45th day or whatever day you put in that blank. The buyer can only terminate the contract if the buyer gets an Equal Credit Opportunity Act adverse letter which says the buyer doesn't financially qualify or that the property doesn't qualify for the loan. I've only seen one of those in the past 10 years. I didn't think lenders ever gave those because they didn't want to give hey, you're turned down because you don't qualify or the property doesn't qualify. I've seen letters that said you're not getting the loan, but I've never seen the Equal Credit Opportunity Act letter that qualifies. And I can tell you when I did get one, I was shocked. Because I just never saw them. I didn't think they ever got them. Just like I don't think they ever give mortgage approval anymore either. But I have seen one of those in the past 10 years. I think one, maybe two. Okay. So the buyer has to get that, or the buyer has to get to closing and provide, under the contract, is supposed to provide evidence from the lender that the buyer made a timely loan application and a diligent, good faith effort and neither got loan approval or denial. Now the contract says that's what the buyer has to provide. Okay, and that's in response to my telling everyone on Legal Resources a few years ago that every time the seller wanted the deposit under a finance contingency contract, I would ask the buyer for proof that they applied for the loan and complied with all the lender's requests for cooperation. And a lot of attorneys looked at me and said, oh, you can do that? And I said, absolutely. We do that every single time the seller wants to forfeit the deposit. A lot of sellers say, no, I don't want the deposit, I'll just relist the property. That's a business decision a seller can make. I don't bother with it at that point. Okay, I don't encourage sellers to forfeit the deposit. It's their choice, but they have the right. The property's been off the market and the buyer doesn't close to see did the buyer actually make a good faith effort to get a loan. If they didn't, then the buyer isn't supposed to be able to get out of the deal. Okay? Now, what does good faith effort mean? It means that the buyer did everything timely, complied with all the lender's requests, paid all the expenses the lender asked to be paid. Okay, and if the buyer's done all of those things, even to extend the closing 10 days, the buyer can be forced to provide proof that they've done that. Remember, the extension for the closing is mandated under the contract. The mandate is that the buyer makes a good faith, diligent effort timely to obtain a loan. If the reason we need 10 more days is because the buyer didn't apply on time, the buyer doesn't get those 10 extra days. Everybody understands that? So I think there's a misconception a lot of times when I speak with realtors that the NABOR contract, oh, you can get the loan and if you waive it, don't worry, you get 10 extra days, no matter what. That's not really how it works. Clause talks about 10 extra days if needed by the lender for CFPB requirements, okay? That doesn't say if needed by the lender because the buyer didn't apply on time, or if needed by the lender because the buyer didn't provide income tax returns. So be careful with that, because once again, that'll happen. And those 10 days, although you hear from the lender all the time, oh, everything's great, everything's good. Anybody here ever had a financing fall through that the loan officer said everything looked great? Okay, it happens all the time. And you have to explain to your customer that there's two parts to the bank. One is the loan officer, that person is in sales. Salespeople don't make money telling people bad news. Then there are the folks who actually process the loan. The loan officer will say, I don't know what happened. It looked so good. Everything was great, okay? So your folks have that report from the loan officer and are gonna use that to waive the financing contingency. You better darn sure make sure you have something in writing that you explained all the risks of potentially losing the deposit, because I have seen those fall apart. I had a deal some years ago that fell apart because the people processing the loan kept dying.
Oh my God.
Okay, one of them, well, actually not all of them. The first one left early on maternity leave because she went into labor long before she was supposed to. And the person that took over the file did get run over by a truck, and I believe they were killed, and they never got the loan, okay? But it looked great, and as far as I could tell, my client was eminently qualified to get a loan, but they just couldn't get it because the lender couldn't get it done because of what happened on that side. So again, they waived the financing contingency because they have a pre-qual letter, right? You guys ever get those? Okay, I'm not a big fan. I don't think they really count for anything. Go to the lender and say, well, I'm really rich and I have great credit. Can I get a loan? And the guy goes, oh yeah. Writes it down, take that, go buy a piece of property, okay? So be careful with those, right? So that's the danger. And the danger is when these people don't get a loan and they needed the loan and they can't cover it with some other deal, some other money they've got. You know, the deposit is at risk, and whatever that deposit is, that's potentially you're at risk for as well. So be really careful when they want to waive the financing contingency. Okay. Now, last thing I want to talk about on the NABOR contract is how do you give notices? Okay. The NABOR contract makes it very clear that you can provide notice to the realtor involved with the transaction, and that notice is notice to a party. So you can provide notice to the party, a party's broker, or to the attorney representing the party in the transaction, and that's in the NABOR contract. And notice is effective when given, okay? And that's important because if you're going to give notice and you can get the notice to the attorney doing the closing or notice to the other broker, that's effective when it's given. So be careful with that. The other thing under the NABOR contract is it makes it clear the day ends at 11:59 p.m. We've had a lot of people that thought the day ended at 5 p.m.
And the notice cannot be done by text, but it can be done by email or writing.
That's not in the NABOR contract, but that is Florida law. That text is not a writing. Therefore, the notice has to be by email, personal delivery, U.S. mail, I want to use that, Federal Express, has to be in writing. It can be email, but it can't be text. Okay. DocuSign will be fine. Okay. All right, so that's the NABOR contract. So let's talk about FRBAR. First thing about FRBAR that's different is that FRBAR makes it very clear in a clause in the FRBAR contract that time is of the essence. And that means time is of the essence for everything. So the NABOR contract doesn't say that. We think the 5 days to apply for a loan is probably a drop dead date, but the contract doesn't say that. But the FRBAR contract, every deadline is a deadline that doesn't get changed. So be careful with that because all of these things become important. It doesn't give us any wiggle room later on, and if you're used to dealing with the contract and arguing with people about time is not of the essence. Or if they're from New York, in New York, nothing is of the essence up there, believe it or not. The closing date will happen when it happens, you know, it's just like, I always thought people from New York would be really hard chargers and everything would have to be just right, and no, and real estate deals up there, it's like on or about, we'll get around to it someday, we'll let you know, so dealing with people from New York, and there are more of them have found the west coast of Florida. So they're coming down, and they're used to doing business that way, so you have to be really careful with them and make sure they understand these things, especially if you got a FRBAR contract, because there's no wiggle room there at all. Under NABOR, there are a lot of things, even if it doesn't say time is of the essence, there are a lot of things that might be because of circumstances and the verbiage in the contract. But under FRBAR, there's absolutely no question. Every deadline is critical, so make sure they know that. My first dealing with New York people years and years ago, the folks went on a cruise for 2 weeks, about 3 days before closing, and we couldn't find them. This is back before you could reach people on boats, so it was really, I thought they might have died. Nobody could locate them, didn't know who to get in touch with. I had phone numbers and stuff for them, so that's when I realized New York does things differently. So be careful with them, okay? Now let's talk about the financing contingency. It's much different than the NABOR contract, and so it underscores the importance of, if you're dealing with a contract form that you don't usually use and you don't really know, associate yourself with somebody who is familiar with it so you understand what you're doing. Because this is a great trap for an ethics complaint and a malpractice lawsuit is walking into a contract that's got clauses that you don't understand, that you don't work with, you don't go through any training on. FRBAR is like that. And we're seeing a few more of those these days because they come over from Miami, they want to use a FRBAR contract, or some of the large national brokerages like to use one contract form, and they will require their agents to use FRBAR because it's a one-size-fits-all for the whole state. And that makes it easier for them to learn the contract and deal with it rather than trying to deal with NABOR. The NABOR contract is tailored to Southwest Florida, so we think it's a much better contract for using locally, but FRBAR is a reasonably good contract as well. So the FRBAR contract, financing contingency, is contingent on the buyer obtaining loan approval. Okay. If you don't fill in the blank with any different time, within 30 days of the effective date. During that same time period, the contingency also requires an appraisal or alternate valuation acceptable to the lender. You know, look what that does to the loan process. They get loan approval and they don't get the valuation or appraisal. And when does the lender order the appraisal? Does anybody know?
Usually
After loan approval, right?
Yep.
Because that's a cost item they're going to pass on to the borrower. And the lenders have found over time that borrowers are not really happy to pay an appraisal fee for a loan they didn't get. So they got to go try to collect that. So they're not going to order the appraisal until after the loan's been approved. It's one of the last things they do. Okay? But the FRBAR contract says these are the contingencies. Buyer getting a loan approval and getting an appraisal, alternate valuation acceptable to the lender by that same deadline. Okay? Now that means that what goes on next is if the buyer doesn't get out of the contract for not getting those criteria met, the buyer can't later get out of the deal and say, oh, I got loan approval, so I told you I got it, so now we're not contingent on financing. Oh, I can't close the loan because it didn't appraise. It won't work, okay? Because those are the two things that have to happen. And most of you will say, oh, if you got loan approval, then you've met the FRBAR contract. You have to tell the seller that you got it, forgetting about the appraisal or other alternate valuations. So there's a danger in using that form if you're not familiar with it, because that's the Achilles heel of financing under FRBAR particularly. Loan approval isn't really going to get them a loan if the property doesn't appraise. The property's not going to appraise till we get closer to closing most of the time, okay? So be careful with that one, okay? Now, what does the contract require that you fill in on the blanks? Just like NABOR, got to fill in the type of loan and the terms. It's a 30-year default for term. It says prevailing rate based on the buyer's creditworthiness. Now there's what the FRBAR contract defines as the interest rate for the loan. I told you my opinion of the term prevailing rate, market rate, all those. And then they add in, because it is different depending on whether there's a 900 credit score, if there's such a credit score, and 650, okay? But how do we determine, you tell me, what is the prevailing rate for a buyer with a 690 credit score for a 30-year fixed rate mortgage? Call the loan officer at BOA and ask. I bet you they don't know. Okay. So this is a lawsuit waiting to happen. It's a great lawsuit. It's a great law school question of what happens when the guy doesn't get a loan, because this is what happens, okay? So, or that the interest rate comes in higher than what Marv would call market, and yet it's consistent with the prevailing rate for that person's credit worthiness, right? Now, is that the right interest rate? Now, if your buyer wants to back out because the flood insurance rate went up, buyer might really want to back out if his loan is 7.5% instead of 5.75%. Okay. So be careful with that term. I don't like that term. I think it's scary, but it is a contract, and I can assure you, being familiar with a number of people on the FRBAR committee, they didn't put this in without a whole lot of arguing about what this term should be, and that's why they settled on this. Okay? So the buyer under the FRBAR contract, just as under NABOR, has to make a good faith, diligent effort to obtain loan approval within the loan approval period, and thereafter to close. Okay? So what happens during the loan approval period? Okay. First, the contract specifies that loan approval that requires the buyer to sell other property does not qualify. And why does it say that? Because somebody on the FRBAR committee had a deal that had a problem like that. Have anybody here ever had a loan approval that was contingent on selling somebody else other than the one that was just about ready to close? Okay, well that wouldn't fly under this, okay? So the buyer does get loan approval during the 30 days, right? The buyer also has to make a good faith diligent effort to obtain the loan, and if the buyer fails to do that, the buyer's in default, okay? So once again, you've got the same thing. The diligent effort is defined in the FRBAR contract as timely furnishing and paying. So timely providing all the documents requested, all the information requested by the lender, and paying all the expenses of the lender. Now, under the FRBAR contract, the buyer is required to keep the seller and the broker informed of the status of the loan upon the request of either the broker or the seller or both, okay? And the contract authorizes the lender, the mortgage broker, the closing agent to disclose and to release preliminary and closing disclosures to the broker and the seller. So one advantage to a seller under the FRBAR contract is you can require the buyer and the lender to provide information about what's going on with the loan. Anybody here ever had the frustration trying to find out what's going on with the buyer's loan? I think buyers have that frustration, let alone the listing agent and the seller. The FRBAR contract requires that the buyer provide that information, okay? And that the seller and the broker can get that information direct from the sources, okay? Now, doesn't necessarily mean that the lender's going to give you that information, but they can under the contract. Doesn't force anybody to do that. And the ability, my experience in this is the ability to get that information depends in part on your relationship with the lender and whoever's working on the loan. Okay, because if you have no relationship with them at all, they have a tendency to say, well, I don't care what the contract says, we're not giving that to you, okay? So really have to rely on the buyer to get that information, okay? Now, under FRBAR, who can the buyer give a notice to? NABOR says, I told you, it can be to the broker, it can be to the attorney, it can be to the party, okay? The FRBAR contract is silent, okay? However, the notice must be in writing, and the notice that we're talking about here must be within the loan approval period. Now, the notice that the buyer has to give to the seller during the loan approval period, and remember, the default's 30 days. What's the current time for processing a loan? Does anybody have an estimate on that? Where somebody could say, okay, you've been approved.
45.
Okay, so here's a good example. If we use the default, somebody just said 45 days. We use the default period of 30 days in a system that's requiring 45 days to get to loan approval. We got a contract that ain't gonna happen in 30 days. So let's get to the 30 days then. And here's what happens. At the end of the 30 days, or before the end of the 30 days, the buyer has to give the seller notice that the buyer has obtained loan approval in writing, or, and this is the option, the buyer may deliver written notice that the buyer is satisfied with the buyer's ability to obtain loan approval. It's almost the same thing. And it works to be the same thing, right? If the buyer gives that notice within the 30 days, it converts the contract into a cash deal. And if the buyer fails to close, the deposit is forfeited unless it's because the seller defaulted or it's due to a property-related condition other than appraisal, which remember is in the approval period, not otherwise waived by the buyer under the contract. So it's a property condition, maybe it's an environmental issue, maybe what happens after a hurricane, something that they're not going to loan on it because the property doesn't meet zoning. Okay, then your buyer still has the opportunity to get out. But otherwise, it's a cash deal. Okay, if the buyer can't get or timely meet the loan approval terms, then the buyer can terminate during the 30 days by a written notice to the seller that the buyer was unable to get the loan approval or can't meet the loan approval requirements. Okay. And if the buyer does that within the 30 days, then the deposit's refunded to the buyer and the contract's terminated. Now, what would I do for the seller in that situation? As I said before, I asked the seller, do you want to ask for the deposit? If the seller says yes, we then require information. Under the FRBAR, it's a lot easier for me to get it because the buyer has to provide it to us, status of everything, okay? And if the buyer hasn't diligently pursued a loan, and that's the real reason the buyer can get the loan approval, then we've got the door open saying you don't get to get out of the contract, just as we did under NABOR, okay? Now, if the buyer didn't do anything, and this falls on you because often the reason the buyer didn't do anything is because you didn't tell the buyer they needed to do something. And whether you told them or not, if you didn't tell them in writing, they'll claim you didn't tell them. Okay, so again, build your operational system so that you're doing all these things. You appear to be very professional. You're taking care of everything. You're sending things in writing to make sure everybody's notified. You're also protecting yourself, okay? So if the buyer doesn't do anything, okay, it's a cash deal. Just remember, the buyer's right to terminate the transaction is limited to the 30-day loan approval period. At the end of that, by the end of that time, the buyer there has to say to the seller, he's required to give the seller notice when the buyer gets loan approval, okay? Or if the buyer wants to get out of the deal because they didn't get loan approval or can't meet any loan approval criteria, the buyer has to give notice of that. If the buyer doesn't do that during the 30 days, then the buyer is stuck with a cash deal, okay? However, if the buyer doesn't do anything, right, then at the end of the 30 days or whatever other period you put in for loan approval, buyer has 3 days, the seller has 3 days to terminate the transaction, and the buyer will get the money, the deposit back as long as the buyer is not in default, otherwise in default, okay? Now, that's important because if the seller wants to get out of the deal anyway, and we did see a few sellers wanting to get out of deals when the market was on fire and it was going up like an escalator. So if you've got a seller like that, they really want out, there's only 3 days here that they can do that. Okay, and remember, time of the essence under the FRBAR contract, so we're not gonna get a 4th day because we didn't quite get around to it. So be careful with this and be sure you remember that, because especially if you've got a backup buyer waiting in the wings, your seller wants to take that contract, this is their only time to be able to terminate prior to getting to closing and the buyer defaulting, okay? Unless the buyer lets them off the hook. This is always subject to the buyer and seller agreeing to do something different, okay? So, under the FRBAR contract, there is no special provision as there is in the NABOR contract that notice to an agent is effective notice to the principal. However, even as a transaction broker, you do have representation obligations to respect to whichever party that you're working with. So it's my opinion that notice to the broker or the attorney will be sufficient notice to the other party. And that notice does have to be under the FRBAR contract by personal delivery, facsimile, mail, or email. Okay, that is specifically in the contract. Now, keep in mind that an attorney does stand as an attorney-client as the agent for the attorney's client. A title company does not. So if you've got a transaction and you're going to give notice, your buyer is giving notice, the seller is giving notice to a title company, that is not legal notice under the law, and that won't work as being an agent because the title company has no representation ability with respect to whoever their customer is that they're writing a title policy for. So if you have an attorney in a transaction or the broker, you can give notice there. But if there's no broker, or you're not going to give notice to the broker, and there's only a title company closing a transaction, notice the title company will be ineffective, and I don't want you guys to get hoisted on that as problematic because you don't know how to get a hold of it. You don't think you can contact the other party directly, well, your customer can. And although you may not be able to do that, your customer can. So be careful with those notice provisions, okay? And that concludes our presentation. Anybody have any questions? All right, I promise you'll be out here by 1. Oh, Marv, you're gonna make us
Just
stay.
a comment, because while these were drop-dead dates in most cases, those can be modified with an amendment. So if there's a need for additional time for any of these factors, an amendment to the contract can be extended, correct?
Correct. If the point being made that all of these deadlines can be changed by amending the contract. So and it really works with this 30-day loan approval period.
I say that because it's going through one of those now.
But be careful with those, because what breaks my heart as much as anything working with realtors is when a realtor is working with another realtor and they've got an issue and it's resolved or almost resolved, And then whenever the deadline was, the next day they find out that the rug is going to be pulled out from under them and the other side is no longer resolving on the basis that they thought, that's a liability trap. So you gotta be really careful with that, not to let that deadline go by before you have the amendment. And remember, dealing with the sale of real property, so everything has to be in writing and signed by the parties. A text is not a writing signed by the parties. And Generation Z loves texts. So you have to right out of the bat explain to them that text won't work. Do your very best to make them understand that, because they think email is old school, but it will work. And I think most of them still do email, although they don't want to. Okay. Anybody else have anything? All right, we're done. Have a great day.